While many retail investors were panic selling silver during the latest sharp drop, larger institutional players may have been doing the exact opposite behind the scenes. Silver's sudden fall from around $82 to nearly $76 shook confidence across the market. Social media quickly filled with fear, bearish predictions, and claims that the rally was finished. Many traders who were calling for triple-digit silver prices only days earlier suddenly flipped bearish overnight. But this kind of emotional reversal is common during strong commodity bull markets. Experienced investors understand that major uptrends rarely move in a straight line. Violent pullbacks often force out weak hands before the market resumes higher. And according to several market signals, that process may already be happening now. One of the biggest clues is institutional accumulation activity. During the sell-off, several indicators suggested professional money was quietly stepping in rather than exiting. Silver mining stocks held up better than expected. Physical demand remained strong. And COMEX inventory withdrawals continued instead of slowing down. That behavior matters. In genuine bear markets, panic spreads everywhere. Mining stocks collapse harder than the metal itself. Physical demand dries up, and inventories rise as investors dump holdings. This time, the opposite pattern appeared in several areas of the market. Another important signal came from the gold-to-silver ratio. Even though silver dropped sharply, the ratio did not explode higher the way it typically does during major breakdowns. Historically, when silver enters a real bear phase, it massively underperforms gold. That has not happened yet. Instead, the recent move looks more like a violent correction inside a larger bullish trend. Several macro conditions also remain supportive for precious metals overall. The US dollar failed to rally strongly during the panic. Physical demand from Asia continues to stay firm. Silver is still holding above key long-term breakout zones. Industrial demand remains elevated. Supply deficits have not disappeared. That combination keeps many long-term investors optimistic despite the short-term volatility. Why violent corrections often happen in bull markets. Strong bull markets tend to create emotional extremes. That appears to be exactly what silver just experienced. The decline happened extremely fast, nearly 7% in under 2 days. Moves like that are designed to trigger fear, margin calls, and forced selling. But historically, some of the biggest future rallies have started immediately after those moments of panic. Historical examples. In previous silver bull cycles, violent crashes were often followed by huge rebounds. In 2010, silver dropped sharply before eventually exploding toward $48. During the 2020 COVID crash, silver collapsed near $12 before rallying above $20 within months. Even severe pullbacks inside bullish cycles later became major buying opportunities for patient investors. That does not guarantee history repeats itself, but it explains why experienced traders pay close attention during panic phases instead of reacting emotionally. Signals smart money may be watching. Several areas are being closely monitored right now. Mining stocks holding strong. Silver miners did not collapse as aggressively as silver itself. That relative strength can sometimes indicate institutional buying underneath the surface. When professionals expect higher future prices, they often accumulate quality mining companies during weakness because miners typically outperform during recoveries. Physical demand staying firm. Physical silver premiums have remained relatively elevated despite the price drop. Normally, during true market collapses, premiums weaken as demand disappears. Steady premiums suggest buyers are still accumulating physical metal during fear. COMEX inventory withdrawals. One of the more interesting developments is continued inventory drainage from COMEX vaults even during falling prices. That could suggest long-term buyers are still taking delivery instead of abandoning the market. Why sentiment resets matter. Before the crash, silver enthusiasm had become extremely overheated. Predictions of immediate moonshot prices were everywhere. Markets rarely reward crowded optimism for long. The recent drop completely shifted psychology from greed to fear within days. Ironically, those emotional resets often create healthier conditions for future rallies because speculative excess gets removed from the system. In other words, the market may have needed this correction. What investors are watching next? The next few trading sessions could become extremely important. Bullish investors want to see silver reclaim higher resistance levels. Mining stocks continue outperforming. Strong buying volume during rebounds. Gold to silver ratio stabilize again. Physical demand remain elevated. If those signals strengthen, confidence in the larger bullish structure could return quickly. However, risks still remain. If silver breaks below major support zones and fails to recover, the market could enter a deeper correction phase before any sustainable rally resumes. That is why many experienced investors focus on risk management rather than emotional predictions. Final thoughts. The recent silver crash created fear across the market, but fear alone does not automatically mean the long-term trend is broken. Many historical bull markets experienced violent shakeouts before continuing much higher. Right now, several indicators suggest professional money may still be accumulating while retail traders panic. Whether this becomes another temporary correction or the beginning of something larger will depend on how the market behaves in the coming weeks. But one thing is clear. Moments of maximum fear are often where the biggest opportunities and biggest mistakes are made.